Hi, everyone. Give me just one more. Just adjust one thing on the microphone. There we go. So overall, pretty interesting day. Big sell-off and big rally. I'll talk about that in just a few minutes. Feel free to ask questions in the comment section. Let me just see one thing over here. There we go. So overall, let me draw a couple of lines. And I like to draw the lines, at least for this when I start it, just to give everybody an idea of what I would look for on the open. And the first thing I would look for is, we know where the high of the day, there's three obvious things. There's the high of the day, there is the low of the day, and the open of the day. Those are three locations you always know beforehand. Now, on a day like today, on a day like yesterday, when the range is so big, you're probably not going to reach the low of the day. But one thing you can feel certain about is we had consecutive buy climaxes, and you're probably, let me expand this a little bit. There we go. It's reasonable to assume that the market will test the third leg. There we go. So where's the third leg? Right here. And let me actually turn this off and turn on one piece here. Give me just 1 second. I want to turn on a bar counter for everybody. There we go. And if I did not say it a few minutes ago, go ahead and ask questions and put them in the comments, and I will read them. Well, I will review a number of them after the review. There we go. So these are the few things I was thinking about on the open. The 59 low, which was the bottom of the third leg, 3 consecutive buy climaxes. It's basically a parabolic wedge. A wedge, it really is 3 pushes. It does not necessarily have to be a perfect shape. It's just, we broke out to the upside, we broke out again, we broke out again. It's 3 attempts to rally, and it's climactic, so you expect some sort of a pullback. So on the daily chart, the one thing I thought coming into the day was we had a big gap up Friday. And because of that, that made me think that today was either going to be a bear trend day or something of disappointment, a small bull trend day, uh, a bear bar. I didn't think we would reverse all of Friday. I did think we would get above yesterday's high, so I was a little bit surprised we didn't. But very small bar. It's an inside bar. It's a pullback. Probably buyers below and going to go a little bit higher. But this is a warning. It's confusing. We have a big bull bar, and now we have confusion right on the close of this. So why was Friday a really big bull bar and today is a small follow through bar? That's always a warning that something's wrong. And that's classic trading range price action. So let's do this here. Actually, let me make these bars bigger. So it's easier for everybody to see. There we go. So first bar of the day, we had a big bear bar, but look at the context. I've mentioned the bar 58 low right here. So Y apostrophe S is yesterday's. Let's just call it 59L for low. Bar 2 and bar 2 reversed bar 1. So bar 2 is a bull bar. You can call it a bar 1 a pullback after the rally from 80, but bar 1's a big bear bar, bar 2 is a bull bar, which means on a 10-minute chart we have a doji probably going to go sideways. 3, we have an inside bar. It's a triangle. It's a tight trading range, probably buyers below, sellers above. I do think we're going to try and get down to the 59 low. Therefore, there's probably buyers somewhere down here, but they may not come in until all the way down here. So we could easily get a measured move of the 59 low. Second entry short, though, it's probably okay to exit. Probably okay. Some bears will sell, but it's a tight trading range, and most traders should wait for a breakout. Bar 4, surprise bar, breaking below yesterday's 80 low, but it's possible wedge 71, 78, or 80, and then bar 3 or bar 4. Bar 5, consecutive bear bars, probably always in short. 3 consecutive bear bars, enough of a surprise that we're probably going to go at least a little bit lower. But trading range in here near the bottoms of a trading range. So the downside is probably going to be limited. So you will have traders selling, but I suspect the selling is more of a sell vacuum test of this low. Therefore, there's probably more buyers in this area than sellers. Bar 6 is a bull bar. It's a reversal attempt, but after 3, 4, and 5, probably the first reversal up will be minor. There were bulls who bought the 1 low and the 2 low and the 3 low, and they scaled in lower. They're going to be disappointed with 4 and 5. And you know those bulls are looking to exit. They bought the 2 low, they bought the 3 low. In other words, they bought the breakout point here. They scaled in lower. Their first entry is the breakout point. They're going to exit. Other traders, instead of buying the bar 3 low or the 2 low or the 1 low, they just bought more lower. Maybe they bought, an average bar range down and just bought the close. They have targets up here as well. And the bears know that. So what are the bears going to do? The bears are going to look to sell around the 3 low. And then we have a surprise bar on 7. Decent 2-bar reversal on 6 and 7, but it's a micro channel since bar 1. So it's basically a 6-bar micro channel, probably sellers above, scaling in lower, scaling in higher. But 6 and 7 is enough of a disappointment that there's probably buyers below, scaling in lower. So we have a big sell-off and a big rally. Is it always in long? It might be, but 2 consecutive bear bars, 2 consecutive bull bars below the moving average. It might be more always in short. Plus, we have the 59 low just below. But this is a problem for bears. If you sold the 5 close or the 6 high or even the 5 high, what are you thinking on 7? You're disappointed. And if you're disappointed, you'll probably look to exit on any bounce. 8, surprise bear bar, but 7 here is a bad low 1. And that means there will probably be more buyers below. 3, 4, and 5 were strong enough for a second leg down. It's possible 8 is the start of that second leg. And the one thing you should notice today is the follow through is disappointing. You get a bear bar and then you get bad follow through. So you get a bear close on 4, bad follow through 5, 6, 7. Bear bar on 8, bad stop, bad signal bar below 7. What do you think the follow through is going to look like? It's probably going to be something disappointing. For the bulls that bought the 7 close, they bought for really 2 reasons. They saw it as a breakout, and that's reasonable. But the problem with buying the 7 close is you have to buy more down here. So if you're buying the 7 close and you put a stop 1 tick below 5 or a tick below 6, it's a mistake, because if this is a trading range, which it probably is, there's probably going to be more buyers down here than sellers. So a lot of bulls, if they bought up here, they're going to buy more down here. And many bulls who buy the 7 close are really, I think they'd be buying a small position. They're buying the 7 close in case it goes a lot higher. But the reality is, if you're buying the 7 close, you're buying a 50% pullback from the 3 bar sell off, 3, 4, and 5. And you're also buying the breakout point, either 1, 2, or 3, where the bears got trapped during 4. So it's not ideal. 9, bear bar for follow through, but it broke below the past, all the bars to the left and the 59 low. But why is 9? Why is it a small bear doji? It's a small body and big tails. If this was going to be something strong, why don't we have a follow through? Why doesn't 9 look like 8? The reason it looks like a small bar is it's a warning. Traders are scalping out and bulls are buying below bars, and then 10 reverses up. What about buying above the 10 high? You can, but fairly tight channel. The sell off on 4 and 5, these 3 bear bars, are strong enough for probably 2, maybe 3 legs down. So it's possible we have to go below 10 and form a wedge with 5, 10, and then somewhere down here. And then 11, we have pretty much a low 1 short. We broke out to a new low on 9 and 10. We pulled back on 10. And now we're trying to form a low 1 on 11. And then 12, we have a bear bar. Weak follow through below 11. Trying to close below yesterday's bar 59 low. But when you look at the sell off, it's got a lot of buying pressure. It's a tight channel, yes, but the reality is it's probably more of a bear leg in a trading range than the start of a strong bear trend. And then 13, you can see tested all the way up here. So the bulls that bought the 11 low, the 11 close, or the 12 close made money on a scalp. Bar 14, it's a reversal bar. You can call it a wedge, 5, 10, 14. So wedge bottom after a strong breakout, spike, pullback, channel. Bears, I would exit above 14. Aggressive bulls may buy above 14, betting on a test of the open of the day. So always in bears, exit above 14. 15, strong entry bar, decent close, closed above several bars, past 5 or 6 bars. Is it always in long? It might be, but the bulls really need one more bar. So far, this looks good. The bears, any bear that sold the 14 high is now trapped, and they will probably use any pullback to buy back shorts. But it would be better for the bulls if they can break above the moving average, this blue line, and close above it. And then 16, now we have 3 consecutive bull bars, always in long, yes. We have an open gap, 15 high, 16 low, good for the bulls. So probably buy the close and going a little bit higher. First target, open of the day, this green line, and open of the week. And it's possible we get all the way up to Friday, which is last Friday's high. And then 17, we have a small body. So 3 good bull bars, 14, 15, and 16, but 17 is a small body. So you have to wonder, why does 17 have a small body? And then 18 is a bear bar. We have a wedge bottom with 5, 10, and 14. Therefore, reasonable to expect 2 legs up. This is probably the start of the first leg. We don't know how deep the pullback will be, but the odds are the bulls will get at least a second leg up. 19, we have an outside up bar. And then 20, we have another strong bull bar. Getting close to the moving average, 2. You can see we're testing the 2 close. Some bulls bought the close of 2, disappointed on 3, and some of them got out. Others bought more lower. And this will be an area where they will look to take profits. And then you can see on 21, we reversed up, testing the 2 close, and then reversed down. So we have 2 legs up, 16, 14 to 17, pull back on 18, and then the second leg being 19 all the way to the 21 high, and the market reversed down on 21. 2 legs up, possible top of a trading range. It's okay for traders to exit longs and look to buy lower. Whenever you're in a trading range, you always have to be worried about risk reward and being high in a trading range or being low in a trading range, because the pullback could go all the way back to the breakout point, the 14 high, or even fall below 14 before there's a second leg. But the reality is this channel up is tight enough, probably the first pullback will fail. 22, it's a high one buy, and the bulls see 21 as a pullback. However, 22, it's a high one buy with the doji, and it's in a trading range. Whenever you have a high one in a trading range, that will increase the odds of it failing. High ones are great in strong trends. We have a breakout on Friday, bars 1 through 4, pulled back on 5, and then 6 is an inside bar. That is a good high one. We gapped up. We have 4 strong bull bars. Bears are not making money on the open. That's a credible high one, probably going to go higher for a second leg. So high ones are great when you think the odds are you're going to get a second leg. And if you think about the logic of a high one, how often do you get pullbacks that just go for 1 or 2 bars? In other words, we broke out to the upside on 19 and 20. We're pulling back 21, 22. Here, we broke out to the upside on 16 and 17, pulling back on 18. So buying, technically speaking, the high of 18 is a high one buy. We went below 18 and we triggered a high one above 18, or you can say the high one above 19 is the high one. Trends typically get weaker. So if you're looking from the perspective of a high one, do you really think that we're going to get a high one here that goes up, pull back, and then get another high one? Also, look at the signal bar on 21. It's a decent sized body. The bars, this is good for the bulls, but it's still within the context of a trading range. Plus, the signal bar is weak. So there's probably more sellers above 22 than buyers. And you can see so many traders tried to sell the high of the bar that a lot of traders just sold the close so they could get into the trade. Some bulls will exit on the 22 close, betting on lower prices. 23, we have another bear bar closing on its low. For the bulls, they will see 2 legs down. Leg 1 being 20, pull back 22, leg 2 being 23. And then 24, we have another bear breakout, but it's testing the high of 15. So there's probably more buyers down here than sellers. For the bears, they have a 3-bar micro channel with 3 bars closing below their midpoints and on their lows. Is it always in short? It might be, but the problem with trading ranges is by the time the market's always in short, it's time to do the opposite. And that's what happened. That's what I mean by opposite. Traders sell the close, but they scalp out. Bulls start buying aggressively, and we reverse up. Now, for the bulls, For the bears, we have a 5-bar micro channel, probably sellers above, but trading range day, we got a rally, very deep pullback. We could easily rally all the way back up to here. For the bulls, 14 to 21 was tight enough that the odds were there were buyers below. So the bulls, they bought all the way up. They likely scaled in lower, just like the bears sold all the way down and scaled in higher, like below 21. The bulls will do the opposite. So that means the market may have to get all the way back up here and test the 20 close, the 19 close, or even the 22 high to see what those bulls are going to do. 26 failed breakout below the 15 low, and it's a pullback for the bears. So the bears see a breakout below yesterday's low, 15 low, pullback. Some bears will sell below 26, but 26 is kind of the opposite of 22. 26 is a low one short with a good signal bar, but terrible context. You're selling low in a trading range after a pretty strong rally, and the odds are the bulls will get some kind of second leg after 14 to 20. And you can see we triggered the sell below 26 and reversed up. Good bull bar 27, but let's see the follow through. And then 28, it's a good bull bar, but it's testing the breakout point of the 20 low and the 22 close. So you know there's probably sellers up there. And instead, we got a big bull bar. Good for the bulls, testing the 20 close, 3 consecutive bull bars, probably always in long. I don't know if we ever went always in short on 24. And then 30, we have a bear bar. It's an inside bar. However, it's a possible triangle with 1, 21, and 29. And 30 is a warning that you have bulls selling out of longs. And then we had a high one buy above 30. It failed and reversed down. For the bears, it's 2 legs up, leg 1. So the first leg being 25 to the 26 high, pull back leg 2 to 30. They will see it as a second leg trap, and aggressive bears will sell below 31. And typically, when you get 3 consecutive bull bars, usually there's buyers below, or 3 consecutive bear bars, buyers above. But the problem on days like today is this is a trading range. And for the bulls, they'll see this as 2 legs up. And the risk is real. There's a 40% chance at a minimum we'll break below 25 and go all the way down here. So it's hard to buy below 31, and it's reasonable to exit. 32, we have a reversal bar. You can call it a second entry buy, but with the size of 31, I suspect there might be more sellers above 32 than buyers. Plus, it's at the top of a trading range, and it's common to get breakouts of bull flags. We have a bull flag. It's common to get bear breakouts. In other words, the high probability thing is second entry buys work. You see it in trends all the time. We have a high 1, high 2 on 59. It leads to higher prices. In trading ranges, lower probability events are more frequent. Why is that? The reason is everything that appears high probability, like buying below an extended micro channel or selling above a 5-bar micro channel, normally that leads to a second leg down. In trading ranges, instead of it being, let's say, 60% probable of a second leg down, it's a lot closer to 55 or 50% profitable. Therefore, if you have a higher probability outcome that is lower probability in a trading range, that means lower probability outcomes in a trading range have higher probability than they normally would. That's why you often see bad signal bars that lead to kind of endless pullbacks. 68, terrible looking signal bar, but it led to a strong sell-off. 6 and 7, strong bull bars, but trading range, and it led to lower prices. So for the bears, it's a high 2 buy, or you can call it a high 1. It doesn't really matter. And then the bears got a second leg down on 33. But the bulls, they will see 32 as a sign that the bears are failing and that this is a leg in a trading range. And as long as the bulls think it's a leg in a trading range, bulls will buy the 32 low and scale in lower. I mentioned over here that some bulls would buy in this area and buy more lower. Therefore, 30.22 would be a target. Well, there were bears who sold 26 and scaled in lower, like below 31. So you know what I'm going to say. 26 is a target. And you can see we tested the 26 low over here and immediately reversed up. Other traders, they bought the 32 close. And you know, in a trading range, this is important to write down. Trading ranges, you can typically buy or sell anywhere, use a wide stop and scale in. So bears sell down here, they scale in higher, they get out at their original entry. Bears sell a close of 24, they scale in higher, like below 31, above 30, they make money. Obviously, some got out here. So bulls, they buy the 32 close, thinking it's a high 2 buy. Maybe they're front running the stop entry above 32. They buy more lower and they'll get out break even. 34 is the middle of the triangle. So you know the market is in breakout mode. And I wrote on the blog during the intraday update, I mentioned that we're in a breakout mode pattern here. And we're in a triangle and we're in the middle of the triangle. And so the probability is close to 50-50. I think at this point, there's a credible chance that maybe the bulls try to get to the high of the day. But unless the bulls start getting strong consecutive bull bars, the probability is low. And you can see good bull bar on 34, terrible entry bar. We couldn't even trigger the buy above 34. Micro channel from 35 to 31, so probably sellers above. Low one short below 34. Below 35, probably buyers below. Strong enough bull bar on 34, probably bulls buying and scaling in lower. Some bears sold to 32, 33 close, disappointed with 34, trying to get out break even. And then 36, you can see it reversed up. So now we have a second entry buy above 36. Okay, swing buy, but it's in the middle of a tight trading range, so you know lower probability buy. And then we went outside down on 37, testing the close of 33. There's probably more buyers down here than sellers. And then we reversed up on 38. So do you buy above 38? Well, it's the same problem with buying above 36. You're buying in the middle of a tight trading range when traders are selling above bars and buying below bars. A lot of traders, some of them bought the close at 34, disappointed 35. They used the rally on 37 that went above 36 to get out back at the close of 34. Now we have three pushes down. We sold off on 36, rallied on 37, sold off on 37, rallied on 38. Now we're selling off again on 39. So three pushes down, testing the 34 low. Probably going to try and break out soon, but the breakout might be to the upside instead of the downside. 40, bear close, closing below, breaking below the past several bars, but failing to close below the last of several bars. Is it always in short yet? I don't think so. I think the bears need more. In triangles, it's very common for the market to break to the downside and then reverse up. Bull bar on 41, and then follow through on 42. 42, it's an entry bar, but it failed to close above 41. It's an extended wedge, 36, 39, 40. But so far, disappointment. And then 43, we have a low one short, probably buyers below, and the market went outside up. So more tight trading range trading, just like we had over here. So the market's been in a tight trading range for 10 bars. So you know that the probability is close to 50-50. We're holding below the moving average for several bars. So a possible sign that the market may break to the downside. But we had a lot of buying pressure on 27, 28, 29, 14, 15, and 16. Plus the added fact that Friday was a pretty strong rally. You know that the market may try and get trend resumption. 45, decent bull close. Probably going to go at least a little bit higher. It's a little bit of a surprise. Traders that sold above 43, the 44 high, probably will be disappointed enough with 45 that they may look to exit. So they sold. If they, whether or not they scaled in, they may just try and exit break even. And you can see the bears that sold and scaled in made money. 46 is a small bar, and then 47 is an outside bar. So what does 46 mean? 46 is a sign of hesitation. Rather than bulls aggressively buying the 45 close, they hesitated. They were worried about buying high and possibly buying two legs up. Leg 1 to 43, pull back to 44, leg 2 to 46. And as soon as there was hesitation on 46, the market broke to the upside and then traders immediately sold. What are some other reasons traders sold? We're testing back in this area. Some bulls bought the 29 close, some bulls bought below 30. Other bulls bought for any reason in here, betting on higher prices, and they got trapped on the way down. Therefore, a retest of that area, such as during 47 over here, will probably lead to a pullback. So with 45, I mentioned it was probably going to go a little bit higher, and the odds were 45 would get a second leg up, and it's possible that second leg is 47. 48, we have a high one buy, but we also have a strong enough breakout on 44, 45 that, yes, the second leg might be 47, but it's possible we have to go higher. We also have the open of the day not far above. And with all the trading range trading we've had today, it's reasonable to expect that the market is going to test the open of the day. Surprise bull bar, closed above 48, failed to close above 37. Big enough bar, probably going to go at least a little bit higher. Follow through 50. So some of the traders that sold the 48 high and scaled in higher might be trapped. Good bull bar on 50, disappointing follow through on 51. And then 52, trying to break out to the upside again. But so far, 3 or 4 buy climaxes, testing the high of 21, getting close to the open of the day. So might be more profit taking. There might be more profit taking up here than traders buying. 52, an inside bar. So we're alternating bars. A micro channel, possible start of a small pullback trend, but probably not the start of a small pullback trend. And then 54, we have another inside bar. Some bulls bought the 52 close, disappointed 53, getting out break even during 54. And then 55, we have an outside bar. It's a little bit of a surprise, but you can see it's a wedge. Broke up to the upside on 49, pulled back on 50, rallied for a second leg on 52, pulled back 53, rallied for a third leg on 55. So it's 3 pushes, 1, 2, 3. And 55 is enough of a surprise that the market is probably going to go at least a little bit lower. And instead, 56, we went a whole lot lower. When you get a bar like 56 in a trading range day, really, whenever you get a bar like 56, there's added risk that it's a trap. And you can see here, it's second leg trap, leg 1 to 14, pull back to 55, leg 2 to 56. So in essence, it's a large 2-legged pullback. Let's do it like this. Let me show this on a 15-minute chart. Two-legged pullback. Here's a 30-minute chart. We rallied on Friday, pulled leg 1, ended around 10 o'clock Central Time, pulled back leg 2, ended on 13:30, which is 1:30 Central Time. So enough of a surprise bar. 56 probably going to get at least a second leg down. But you always have to wonder when you see a tail like 56 close to a moving average or other support, it's important to pay close attention to the follow through. Bull bar 57, so reasonable for bears to exit above or exit after two bull closes. 58 consecutive bull bars, probably going to go higher at a minimum, probably going to go to the 55 high in the open of the day. And then 59, strong bull close. Is it buy the close 59? It technically is, but the problem with buying 59 is you're buying fairly far away. We've had a fairly strong rally after a strong sell off, and you know there were bears who sold down here and they got trapped on 57, 58, 59. Some of those bears scaled in all the way higher and they are looking to exit around break even. So, what that means is the market may have to have a deep pullback before there's a second leg up. 60, high one buy. Probably buyers above, but I suspect the buyers will probably scalp. 61, bull bar, but a small bar. After this strong of a breakout, I suspect the bulls are going to be exhausted temporarily and look to take profits and look to buy lower. 62, we have a doji after the bull bar, so starting to get overlapping bars. 63, another bull close, but failed to close above the highs. Tight trading range, probably going to go sideways. 65, surprise bar. 64, surprise bar, but it's a surprise after a lot of overlapping bars, and it may be a climactic end of the move, testing the high of the day. So there might be more sellers up here, but I would not sell the close of 64. We could easily break out to the upside and test the high of the day. Reversal on 65, reasonable for always in traders to exit below 65. Will aggressive bears sell? They might, but to me, I think it's hard to sell when you see this much buying pressure. Plus, you know there are disappointed bears. Bears sold the 56 close, sold more below a bar like 65, or they sold the 57 high or the 57 close and sold more below 65. 68, 66 high one buy, but there might be more sellers above than buyers. Testing the 64 close, so some bulls bought the close 64, disappointed 65. And they will use 66 to exit around the 65 close. 66, second leg down. So some bears sold below 65, disappointed 66, and they use this to buy back shorts. 68, inside bar, broke to the downside on 69, and then 70 went lower. And obviously, we're trying to test an area where bulls started buying and bears started buying back shorts after this strong rally. Probably going to get a second leg up, but so late in the day, we may just go sideways. And you can see we rallied up to 76 and then sold off. Why did we sell off? Because bulls bought up here, scaled in lower, and used this bounce to sell out of longs, just as the bears who sold all the way down sold higher, and they used 72 to exit around the lows of 70. And then we went sideways into the close. So interesting day. And it's common enough on around 1 o'clock or 1 o'clock Central Time, 2 o'clock Eastern Time, 11 o'clock Pacific Time to get a surprise that traps traders in the wrong direction. And whenever you see a bar like 56, 56 is an emotional bar. It's trying to trick traders into doing something dumb, for lack of words. They see a big bear bar and they panic, worried that it's going to crash without them, and they have to get in the trade. But the reality is, smart traders, when they see 56, they say, yeah, that's climactic. I don't want to sell that. I'll sell a pullback, because they know the risk reward is bad. If you're selling this bar alone is it's almost 20 points. It's not quite. It's really about 14 points, maybe 15. But either way, the bar is pretty big in and of itself. And when the range is fairly small, this range is to 41 to about 56. So it's about a 14-point range, really not that big. But whenever you get a bar like this, there's added risk of pullback or profit taking in more sideways. For always in, I think always in is the best way for most traders to trade. Second entry short on 3 might be an okay. If you're aggressive, it's probably an okay sell, betting on a test of the 59 low. Some traders sell the close of 4, sell the close of 5, but 3 pushes down, adds support. If you're selling the close of 5, you really need to scale in higher. So it's really not all that ideal. And reasonable for bears to exit above 6. If they do, they have to get short again, but hard to sell below a bar like 8. Some traders will sell above 9 or 10, betting on a second leg down, but not really all that easy. Low one short 13. I think there will be traders. Bears exit above 15. A lot of bears will exit earlier, anticipating bad follow through on 15. But bears exit aggressive, bulls buy the close, always in on 14, always in long on 15 or 16. So okay to be long. Then you get a second leg up and a bear bar on 21. And you always have to wonder in a trading range when the market reverses, it's never clear. And by the time the market becomes clearly always in long, it's usually right at resistance for the bulls. And then when the market becomes always in short, it's usually really close to support. So, give you an example. 23, is it always in short? I don't know. I think the bears need probably one more bar. It's a possible 50% pullback, bad follow through on 22. It's possible 24 is a strong bull bar similar to 34. But instead, 24 is a big bear bar. Always in short, yes, but you're testing the breakout point of 14, and you're in the zone where bears got disappointed and trapped. So we could easily sell off and find buyers not far below. So, anyways, bears get out below, bulls get out below 21, bears sell, and then sell the close 23, sell the close 24. Maybe, but if I'm selling the close 24, I know I'm selling low. And if I'm selling low in a trading range, I have to be quick to get out. Just as if I'm buying high in a trading range, like up here, I've got to be quick to get out. And my default is if it's high in a trading range and what could be 2 legs up, exit below a bear bar, closing below its midpoint, certainly closing on its low. Bears exit above 25, aggressive bulls buy, betting on a second leg up from the 14 to 21 rally. Other bulls buy above 27, 28. 29, do you buy the close? You can, but you're buying. Think about these bulls for a second. Let's say you bought the 20 close here, and then you're disappointed with 21. What are you going to do? Some traders will scale in lower, buy more above a bull bar, and they'll say, yeah, this is pretty disappointing. Maybe I should exit at the high close if the market will let me. And then traders got out up here. So some bulls can buy up here, but I don't think it's ideal. We could easily fall all the way down here. And it's also 2 legs up. Leg 1 to 26, pull back 27, leg 2. 31, bulls exit below, bears sell. And then unfortunately, bears get out above 34, bulls buy above it, but it doesn't trigger. Some bulls buy above this bar, but if they are, probably stop below 34. And then what do they do there? And you can see you would have gotten stopped out. So really not that easy. And it's what I mentioned earlier in this review. Bulls buying the close of 34, using the pullback of 37 or 36 to buy more lower, getting out at the high close. or you can see 38. Some bulls took a chance betting on an upside breakout. They buy the close, they buy more below 35, hoping for a breakout to the upside, testing the open of the day. And instead, they get 37. They're disappointed with 37. So now they're thinking, yeah, maybe it wasn't clear. I'm going to try and get out break even at the 36 high or the 34 close here. And what do you think 38 did? 38 tested 36 high and it tested 34 close, allowing those traders to exit. 39 is a bear bar. Decent bear bar, closing slightly above its midpoint. Probably, it's, as I said, tight trading range. So what do always in traders do here? I don't know. I think this is a mess. I think it's really easy to end up holding too long. Always in bears get out, bulls buy, or they buy here, and they probably get out below one of these bars, certainly below 55. Bears, if they sell, they get out above here, and obviously bulls buy. But overall, if you're trading with stop entries, it's really, really difficult to trade with stop entries on a day like today. And it's a limit order market. Best stop entries or Walmart trades of the day, probably buying above 14. You can sell below 21, but after this tight of a channel, the odds are there's buyers somewhere below. I thought 14 had a chance at breaking strongly to the upside, but you always expect disappointment, and instead the bulls got two legs up and they failed. And then, other than that, probably the second best stop entry is buying above 57. Limit orders were all day. Traders buying several points below, sellers above bear bars, bulls buying the 6 low, scaling and lower, selling above 10, buying below 11, buying below 13, which was a good limit order buy. And what else? It's not really that easy. Maybe buying 43, betting on a couple of legs down, and a test back up to here. And that's probably it for limit orders. There was all sorts of limit order trades today. Really, most of the day was a limit order market. Buy the close, sell the close. Most of the day was a trading range, so it's opposite day. So you see 4, and it's instead of selling the close of 4, it's generally better to look to buy the close of 4. Or you see an obvious big bear bar, wait for one more bar, and then buy the close. You see a big bull bar, traders fade it. Traders sell the close, betting that the bulls are not going to get followed through. They look at 7 and they think, yeah, it's always in long, probably, but I don't know, maybe the bulls need one more bar. So instead of buying the close of 7, I'll sell the close of 7. Traders buy the close on 15, 16 for higher prices. They can sell 24, but they probably scalp out as the market reverses up. Buy the close 25, 26, or 26, 27, or 27, 28, probably okay. Buy the close 58, 59, all good. What about selling the close of 69? I think it's probably more buy the close instead of sell the close. Let me take a look at a few questions. Katie asked, I don't seem to understand IIs, IOIs, or OOs. An II is an inside bar. IOI means inside bar followed by an outside bar followed by an inside bar, and an OO means an outside bar followed by an outside bar. Well, that is, let's go. Let me read the rest of this person's question. Oh, that's even nicer. I can just do that. Huh. Learn something new every day with StreamYard. So this is Katie's question. I'm going to remove me and just do it like this. It's easier. So II patterns are triangles, and they are all over the place, especially in trading ranges, and they're generally final flags. A triangle is a breakout mode pattern. A trading range is a reversal, or the market's deciding, is it going to reverse out or break out? So here you can see we have let's see if that, no, I don't want to do that right now. We have an inside bar. So it's a pullback, and the market's deciding, is this going to lead to higher prices or is it going to fail and reverse? And there's almost always some version of a final flag before the market reverses. And what that means is it's kind of like right here. We have a pullback in this area, 35 to 38. The market pulls back, breaks the downside, but then fails and reverses. That's very common. Okay, for example, bar 66 here, we have an inside bar, outside bar, and then an inside bar, and then it dropped. When you see an IOI like that, which bar? Okay, so for example, bar 66 is an IOI, and then it sold off. When you see an IOI like 66, do you short? I'm trying to understand the person's question more. Generally speaking, an IOI pattern, it's a flag. It's trying to pull back and break out to the upside, just as these down here, right here. We are trying to basically form, here's an inside bar on 6. Sold off, pulled back. We're trying to sell off and go lower. So, but I wouldn't get too caught up in II patterns, IOIs, and all that. What I would get caught up in is their overlapping bars, their tight trading ranges in larger tight trading ranges, which increase the risk of the market pulling back. Reasonable Walmart trades today, buying above 14, probably buying above 57. I thought selling below 21 is okay, but I mentioned there were problems with it after the tight channel up. The two best ones are probably buying 14 and buying 56 because of the context of the daily chart. Daily chart on last Friday had a strong bull bar, so it's reasonable to expect a second leg up. Interesting day. I can make money with my strategy almost any day, but not today. But it was still only a small loss. Yeah, it's probably because you're swing trading. And that works a lot of days. The tighter the range, days like today. There we go. Days like today are very forgiving for limit order traders. Bulls buying below bars, scaling in lower. Bulls selling up here, scaling in higher, scalping out. Bulls buying on the way down, scalping out. It's a limit order market. How do you react to the big sell-off suddenly? If it started to bottom, if it started in the bottom of a trading range and traders were buying, yes, how do you deal with this? Well, for me, I sold I sold as the market turned down, scalped out. And for me, sometimes what I'll do, I'll sell on the way down and look to sell higher. So I'll enter a small position. And then on the close of this bar, I think I either short below it or shorted on the close, but I wanted to sell higher. And then my target, I had an arbitrary target somewhere down here, and it started going down and it plunged through it. And the problem, whenever you see a bar just skyrocketing down, the risk gets really, really big. And it's, you generally just look at the bar, go find another bar that's 15 points tall. And generally, the market pulls back before it goes another 15 points. So when you see a plunge like 56, I wouldn't worry about it. I think it's easy to panic and sell too low in the bar and get stopped out up here. So to me, this is just you can call it kind of like a beginner's trap, trapping traders into selling far too low. Question: if the market has a strong breakout on the 5-minute, Al says that strong breakout on a higher time frame. Yeah, so if the market has a breakout, or let's do this. Basically, what is fractal markets? Fractal markets is we have a tight channel up from 14 to 21 on a 10-minute chart. So 21 is 1010 on a 10-minute chart. Here's 1010. It's a strong micro channel. Two big bear bars down to 1030. That is 1030. This sell off right here. Two big bear bars, probably sellers above, scaling in higher. You can see big bear bar here, very strong bull bar. 30-minute chart, it's a doji. So big sell off, big rally, that's a doji bar. That's what Al means about fractal markets. Is the leg from 68 to 14 shrinking stairs? Is the leg from 68 to, I'm not sure, you say 68. I'm not sure what you mean there. Whoever asked this question, see if you can restate it. Does 15 count as a close above the EMA? Yeah, it does. It technically, but most of the body here is below the EMA. So it's going to probably go higher, but ideally you'd rather see a few closes above it. When is it a good idea to manage trades to break even? What kind of trades should we do that on? In general, if you can't make up your mind, if the market's moving really fast, you sold on the way down and it starts to pull back and it's just moving really fast, sometimes it's okay to just get out. Traders do it all the time. Trade's not going well, it's acting weird. You're kind of losing. You're not feeling like you're reading the market correctly. It's okay to get out and look to re-enter again. So, maybe you're long and you're saying, I don't know, maybe this pullback, you get out and then you just look to buy again. I think traders do it all the time. In general, try to avoid break-even trades because inevitably what will happen is you'll end up buying something like during 59 as the market's going up, and then you'll hold and you'll get stopped out down here around break even only for the market to pop back up, or you'll buy above 14, unable to get out and get stopped out above 14 on 25, only to watch the market go right back to the target to the high close. So I'm going to look for one more quick question. So let me answer this person's question because they responded, and then I will plan on doing a Q&A sometime this week, a longer one. Question: is the leg from bar 68 yesterday here to 14 a shrinking stairs? Yeah, I mean it's a channel and gaps are closing, so bulls are buying below 70, scaling in. The gap closes, bulls buy below 80, scale in. So yeah, it's a channel that's getting more and more buying pressure that converted into a trading range. All right. Thanks everybody for watching, and I hope everyone got something out of this. As always, feel free to go to the trading course website to learn more information. Hope everyone has a good one.